Let's bring in Dan Niles, founder and portfolio manager at Niles Investment Management. Dan, great to have you with us.
Great to be on, Melissa.
It certainly doesn't seem this way that there is an adoption slowdown when you go through earnings calls, when you hear what companies are saying, but there could be a difference in what they're broadcasting versus what is actually going on in terms of dollars spent. What's your take on this? Because there's always that concern that there's a pull forward, that the expectations were just being bloated to begin with, and that it will catch up with this trade.
Yeah, I think the tough thing is don't confuse what stock prices are doing with what's actually going on fundamentally, because those two things can be completely different for short periods of time. And that's what you have going on right now. You were talking earlier about, the Fed cutting rates starting again that cycle on September 17th, and that's driving these stocks up. But if you listen to what is actually coming out from these companies, it paints a slightly different picture, right? Where, remember, there was an MIT study that came out that 95% of companies weren't seeing any, improvement from their spending on AI. Then you get to company actions, which matter more than these surveys, and you go, all right, Meta, which has been absolutely killing it with their Llama models, now there's talk that they're going to work with either Google or OpenAI to get Llama 5 out. And after spending Major League Baseball pitcher type salaries for AI researchers, they've probably now restructured their AI team at least 4 times in the last 6 months. You look at what's going on with Apple, right? They announced all these AI features for Siri in 2024, but it'll be probably 2026, and they're going to have to work with OpenAI or probably Google following this antitrust ruling to get those features out. So you are already seeing this, and over the weekend it came out that OpenAI has sort of pushed up their revenue forecast for 2030 by about $26 billion to $200 billion. But to get that revenue increase of $26 billion, they're going to have to burn $85 billion more in cash. So the data points are definitely there, but we're in this business to make money. So you have to go, all right, well, do the fundamentals matter right now? Or is it the fact you're going to get even more easy money? The 10-year yield's going down to 4%. And so this market, much like in 2021, will keep going up right up until it doesn't. And so I think you have to look at that. And NVIDIA missing on data center revenues. And you can say, yes, but the growth was so high and all this, but they missed. So that should give you another data point, and you throw on top of that Dell or Marvell, or the fact that Avago's got more ASIC revenues because companies want to cut their costs. Those all speak to the same narrative. So don't confuse the actual data with what the stock prices are doing.
Dan, I think, people who are believers, who are basically pot committed to this whole CapEx story will say, well, sure, companies are not yet seeing the benefits, or they're not yet accelerating their adoption of various AI tools because we're not there yet. And we have to build as fast as we can to get there. The market's permitted a lot of these companies, the entire infrastructure trade, to go pretty far at this point. Is there any sign that the market's going to kind of tighten the reins on that?
Well, number one, I would disagree with your premise that, it's okay to not see returns. We're 3 years into this, Mike, right?
I didn't say it's okay. I'm suggesting the market's been okay with it.
Well, but again, that kind of goes back to the fact that we're looking at rate cuts coming, right? That's been the number one driver of this market really since COVID, and you can argue since Lehman failed, right? So, you have inflation going from 1.4% to 2%. 1.4 to 7% in 2021. The S&P is up 27% because the Fed keeps telling us it's transitory when I think a lot of people, including myself, thought it wasn't. Then 2022, you admit to it, rate hikes happen, the market gets beat up pretty good. 2023, the Fed goes ahead and goes on hold this year, and the market's obviously surges over 20% this year. Looks like rate cuts are coming. Market starts going up. And so that's doing a lot of this driving of it. And that's why it makes it seem like people are okay with this. Because don't forget, NVIDIA is down since they reported. Obviously, it surged a lot off the bottom. But don't forget, like middle of last year when Microsoft, Google, Amazon all had CapEx spending going up while the revenue estimates were actually getting cut. NVIDIA went flat, went sideways for the last half of last year. So, this is a point in time the rate cuts in front of us. That's why if you see a lot of the things that I write, it's, forget about valuations, forget about fundamentals. It's all about easy money. And the party's going to continue right up until it doesn't. My thought has been that's around Thanksgiving when, we find out there has been a big pull forward in demand. But in the near term, the goal is to make money, right? And then being intellectually right, that's something that ultimately will help you make money on the other side of this by being short a bunch of stocks. And I think we're getting closer to that. But for right now, it's stay long and make money.